X limited trial balance X limited. All right, and we've been given this information, other comprehensive income for the year, which is here. So they've asked us prepare the statement of profit or loss and other comprehensive income for Osmosi Otunya Limited for the year ended December 2023. Okay, so this is for Osmosi Otunya Limited. Okay, not Victoria Falls colleagues, Osmosi Otunya. Okay, that's the original name. So we use the original names of things. So, as I said, the purpose of the income statement is just to find out how much profit we've made. There are going to be 4 profits there in the income statement that you need to show. The gross profit, this is the profit after you've deducted your cost of goods sold. You've got your operating profit. This is the profit that you get after you've deducted your operational expenses. Then you've got your profit before tax. This is your profit after you have deducted all your financing costs. Okay, and then finally you've got the profit after tax. Okay, profit after tax. This is after you've deducted all your tax expenses. Okay, so we've got this information here. Right, and now we need to make our income statement. So as we are making the income statement, some of the things I will tell you what they are and define for you. Then after we make our income statement, then we've got our other comprehensive income. Okay, the other comprehensive income, basically these are the unrealized gains or losses for our investments. Okay, so for example, if you have a building and it grows in value by 20,000, okay, that 20,000 increment is an unrealized gain. When you sell that building for, let's say it was originally 50,000, the building, and then it's grown in value by 20,000. So it means the value of the building has now become 70,000. Okay, so when you sell that building, okay, for 70,000 kwacha, then you are going to realize that 20,000 gain in the building. Okay, but as long as you still have the building there, it's unrealized. Okay, yes. So let us begin. Put here Osmosi Otunya here. I'm going to say income statement and other comprehensive for the year ended at 31st December 2023. Okay. So the first thing is our sales revenue. This is the money we've made from selling goods or services. Okay, so our revenue, 544,000. Oh, I think actually let me even use Excel. Excel will be better. Excel will be better. Alright, so we have sales revenue here. $544,000. Then the next item that's going to come in is the cost of sales or cost of goods sold. Okay, this is the value of the goods that have been sold. We're going to put 300,000 here. We're going to say less cost of sales. Okay, this is our first profit, our gross profit. Okay, first profit we need to include. Okay. Next, we've got this gain on disposal of equipment. Gain on disposal of equipment just means we sold equipment at and we got a profit. We sold the equipment for more than it's worth, so we earned like a certain profit from that. Okay, so add gain on disposal. $20,000. Oh, and we've also got interest received. Okay, after you get your gross profit, look for some forms of income that the company has got, right? So even interest received, okay, this is interest that the company has earned, not that it's paid out. No, interest that the company has earned. Okay, so here 8,000. Okay, so we get our adjusted gross profit, 244,000 plus 20,000 plus 8,000, we get 272,000. Okay. Any questions before we now get our operating profit? Okay, now we deduct our operational expenses. Okay, so I'm going to say less, start with administrative salaries, $120,000. depreciation in machinery, depreciation loss in value of a non-current asset, $50,000. We've got amortization of a patent. Amortization also is the loss in the value of an intangible non-current asset. Okay, remember, non-current assets, they are tangible ones, equipment, motor vehicle, buildings. Then we've got intangible non-current assets like goodwill, patents, copyrights. All right. So amortization of the patent. $10,000. We've got this loss in impairment of goodwill. Impairment loss. Impairment is just the sudden drop in the value of an asset. Remember, goodwill, this is the extra value you pay for a company's customer base, its brand loyalty, right? Its location, right? Because remember, whenever you're buying a company that is already existing, the company has done the groundwork for you. They've already got all the customers. If they've got a good location which is near suppliers, that's an added advantage of you. Okay, so when you buy that company, you're going to benefit from the company's previous hard work. So that's what goodwill is. Okay, you're just paying for that. That's the extra value you're paying for the company. Yes, so these are our operational expenses. So we deduct. So this profit, 272,000 minus our administrative salaries, minus depreciation, minus impairment of minus amortization, minus impairment. We get 77,000. This is our operating profit. Okay, also called profit before interest and tax, PBIT. Okay, then we now go to any financing costs. Here we've got interest paid, so you're going to say less finance costs, 12,000. So we're going to say 77,000. 77,000. 77,000 minus 12,000. This is your profit before tax. Okay. Alright, then next we need to deduct our tax. Dividends, the interim dividend, which is a dividend paid during the year, and the final dividends, those we're going to see them in our statement of equity changes. So you're not going to see them in the income statement. Alright, so You're going to say less tax expense, income tax. $5,000. So this is now going to be your profit after tax. $65 minus 5,000. Yes. Alright, so as I said, 4 profits that you're going to need to show on your income statement: gross profit, operating profit, profit before tax, and your profit after tax. Any questions?
Explain the impairment loss. What did you say?
Drop in value of an asset.
Okay.
Yes, for example, if your business has got a car and the car enters into an accident, okay, maybe let's say the car was worth 120,000. Now it goes into an accident and it's rendered useless for a business, and after the accident it's worth now, like, let's say 50,000. So 120 minus 50,000, that's the impairment loss.
Okay, thank you.
Alright, so next we now go to our other comprehensive income. As I say, these are the unrealized gains or losses. Okay, so here first we have revaluation surplus on land. So the land has been revalued and then it's increased by 30,000. Let me just bring them on this side. Okay, and I put these notes here. Okay, I'll just put them here to explain each of these sections here, the other comprehensive income. Okay, so we're going to add revaluation surplus. Valuation surplus on land, 30,000. Okay, land has increased in value. Actuarial loss on pension plan. The company's pension plan has lost 7,000 in value, so we deduct. Now Excel doesn't allow me to put brackets. That's why I'm saying less and add. But in the income statement, what expenses and losses, we're going to put them in brackets or parentheses. Okay, so when I put it on the Word document, I'll put it in the proper format. All right, in the in the comprehensive income statement, you don't need to put this less here. You just put this 7,000 as in brackets to show that you're subtracting it. Okay, next we've got gain on equity investments, 12,000. Okay, so equity investments like stocks or shares. Okay, if the share prices grow in value, okay, that's the gain on equity investments. Okay, so if you have shares worth 50,000 and they've grown in value by let's say 2,000, now their total value is now 52,000. Okay. And it's unrealized because that 2,000, since you are still owning the shares, yes, they have grown by 2,000, but since you haven't sold those shares, so it's unrealized. But the moment you sell those shares for 52,000, then you realize that gain. Okay. So now here it has increased by 12,000. Gain on equity investments. And then finally we have foreign currency translation reserve gain from overseas subsidiary. Okay, our subsidiary, our child company, has become 5,000 kwacha more in local currency. Okay, because remember, some businesses, they're not conducting only operations in one country. They can conduct operations or have subsidiaries in other countries. So those subsidiaries, if they grow in value or they drop in value, we record. Okay, so foreign currency translation gain. $5,000. Okay. So we can say total comprehensive income. $30,000 plus, minus the loss, plus 12,000. This is again plus 5,000. 40,000 here. Okay. Yes. Then if you want, you can also add this and this to get another total, but you can also leave it like this. Okay. Because this other comprehensive income is going to affect your statement of equity changes. Okay. Any questions?